Hello and welcome to KYC, a brand new show at NDTV Profit. In this fast-paced world of stock markets, investors are bombarded with information, but what they often lack is a deep, comprehensive understanding of the companies they invest in. Know Your Company is a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every day. Well, today we're talking about Canfin Homes. This is a relatively smaller NBFC, well focused in housing finance, and of course in terms of its borrowing mix as well. It's about 64% is coming in from construction. That's followed by maybe 7% from mortgage and loan against property, which would also include something like a flat and resale, along with renovations, could include several of the other aspects. In terms of branches, this is essentially a Southern Indian based NBFC with 60% of its branches there, but it does have a significant presence in the western and the northern markets too, where it has about 16% and 14% presence respectively in terms of its overall branches. Moving on in terms of its assets under management, to give you a better breakup of that, about 80% comes from housing, and housing CRE comprises another 10%. So 90% of its assets under management are as far as housing goes, and the balance will be from LAP and mortgages and top up, etc. So what we usually do under all circumstances is that, well, we rate the company on several parameters, and while we do talk about the net interest income, we talk about the balance sheet, the way things pan out when it comes to your operating metrics, along with, of course, shareholding pattern and the street credentials. We tend to rate these companies on all these parameters and eventually get the score coming through. To take us through some of these aspects, we are also joined by Harsh, who's going to help us with at least some of these. So Harsh, welcome to the show and good morning. Thanks, to you as well.
Good morning.
Let's start off with your income statement. How has that panned out, and what are the ratings we're giving it to it?
So the AUM size is roughly 35,000 crores. So it's a fairly small size, right, in terms of AUM. You have larger housing financiers, something like a Bajaj Housing, which is 1 lakh crore plus. You have LIC Housing. And of course, then you have HDFC Limited's book, erstwhile book, which is now part of HDFC Bank, which is the largest at this point. You also have SBI and some other banks which have now started taking sizable positions within the housing finance space. So not only is competition going up, but if you're on a low base, it's fairly easy to grow.
Yeah.
And therefore, that number, 16.5% on top line, that's what's not looking very enthusiastic, just from an opportunity size perspective. So while it's a very healthy growth number, and I would ideally maybe have even possibly given it a thumbs up, but the only reason that held me back from giving it a thumbs up and give it a neutral, because the opportunity size is so large,
right?
And therefore you would want a smaller housing financier, sub maybe 30,000, just sub 40,000 crore, to grow at a faster clip. Right. But it's grown at 16%, and that's how it's shaped up over the last 3 years. You're looking at provisioning also largely muted, and that's a big positive in my opinion. And profit after tax, therefore, has gone up by 18.5% over the last 3 years. So a neutral rating only on the fact that you would want it to grow its top line slightly better than what it has actually done.
Right. Well, for a company this size, as Harsh was mentioning, we usually tend to see well over 20-25% growth in terms of your top line as well as your bottom line. But the company seems to be missing a bit just in this case, which is why we're going to go with a neutral rating here. As once again, Harsh has already mentioned. I'm going to talk about the balance sheet very quickly. And when it comes to the assets under management, as I was mentioning, the majority does come from housing. It has grown from 22,000, a little over 22,100 back in FY21 all the way through FY24. Currently stands at a little less than 35,000 crores. It's not a bad growth. We'll certainly give you that. But given the size and given the low base, it could have been much better. Of course, there are certain challenges when it comes to an NBFC, which is actually a public sector undertaking, And well, if you consider those challenges, sure, you could also, say that this is a reasonable growth rate. But if you do, compare it to several other players which are in the market at the same size, this kind of growth would potentially just give you a neutral rating, which is why we're also giving this a neutral one. But how are things looking when it comes to operational metrics, Harsh?
Yeah, so operational metrics looking decently healthy. So you're looking at yields at just a shade below 10%. Now, what really stands out here is that you're a pure housing finance player, right? And therefore, a large part of the book is housing and mortgage related. But you also have loan against property as a component of the book. But the component is very, very small as part of the AUM. And therefore, to maintain the yield of around 9.8%, a steady spread, and the kind of ROA that it's seen, a slight increase in the ROA trajectory, certainly augurs very well. Even your borrowing cost has actually gone up as a result of the fact that Can Bank has reduced its shareholding in Canfin Homes, and therefore you're seeing a sharp rise there, likely due to that. But they've still been able to maintain their spreads. They've been able to balance it out well. They've been able to keep their margins decently well, and they've been able to therefore do well on the operational side of things, which is why we've given operational metrics. That metric, we've given it a thumbs up. Of course, again, very, very correlative to income statement, but nonetheless, we've given this one a thumbs up, largely borderline to positive on both of those metrics.
Okay, so I just want to make a correction here that I had mentioned that this is a PSU. It isn't, because it's actually held by Canara Bank. It is not held by the President of India, and hence it may be considered as not a PSU entity anymore. But I want to talk about a handful of other aspects as well, and we can perhaps talk about the asset quality metrics too. And in terms of your gross NPA ratios, we have certainly seen an improvement. There's no doubt about that, because we've back in FY 2021, the gross NPA ratio stood at around 0.91. It has gradually improved, and while FY23 and FY22 years were really good, there was a little bit of deterioration, yet as compared to FY21, it's a better ratio, currently standing at around 0.82. Similarly, when it comes to your net NPA ratios, again, it is an improvement if you consider how things have panned out from FY21 through FY24. But there were 2 years where, pardon me, things were considerably better at it, and that's the reason why we'll give this a thumbs up, because we have seen a gradual improvement, even with a little bit of volatility. FY24, of course, will be a year where there could have been some changes. But if there is anything else that you'd like to add in terms of your asset quality metrics, Harsh?
Yeah, it's just a low base, right, Agam?
Yeah.
So when you're looking at the last 3 years, the asset quality has bounced back and normalized off a very, very low base. So that's one. Second is that if you look at the last 5 to 6 years as well, your NPA ratios have been very, very healthy. They've been sub 1%. And therefore gives you that comfort that asset quality, despite everything that's happened with shareholding, as well as with regard to the way in which the leadership changes, etc., have panned out, has sustained in that sense. And there's been no deterioration. There's not been any marked deterioration with regard to where asset quality is concerned. That's how I would look at it.
All right. Well, there you have it. So that's as far as your key financial statements are concerned. Let's move on and talk about shareholding now. And in terms of shareholding, when it comes to promoters, that is Canara Bank specifically, that continues to hold around 30%. Moving on, when you consider, institutions specifically, so you have mutual funds, you have, their shareholding stands at around 22%. Besides that, individuals also hold 19%, which is also quite curious. But then foreign corporate bodies and bodies corporate also have a fairly decent holding of Canara Bank. And which is why, at this point in time, the reason why we want to give it a thumbs up is because the holding for this particular NBFC, that's Canfin Homes, pardon me, is fairly rounded and fairly diversified, which actually, doesn't leave too much room for a lot of manipulation in this case, and which is why we're giving this a thumbs up. But, we're coming then down to how the street is viewing this particular company. Harsh, let's talk about valuations.
Well, yeah. So let's talk about it actually. So let's pull up the valuation picture. There you go. You have Canfin Homes at 2.2 times price to book. You have PNB Housing at around 1.6. Of course, PNB Housing yet to turn a corner fully. So maybe that slightly discounted valuation may likely be fair. LIC Housing at 1 time and Home First. Then you have those entire bunch of housing financiers, right? You have Aptus, Avas, Home First, all of them growing at a fairly healthy clip. All of them more efficient than some of the tier 2 ones like a Canfin, like a PNB, like an LIC. And all of them doing much better in that sense, even where valuations are concerned, because your ROAs are just a very different picture there. And even your margins are a different picture, and even your growth is a very different picture. So those 3 metrics take those valuations at 4.4. We're giving this a neutral because it looks like a fair valuation when you're looking at the top rung, fast growing housing financiers versus the second from top, something like a Canfin, PNB, LIC. Largely this one looks well placed in terms of its valuations as a result of all of those metrics.
All right, let's move on, talk about street coverage then, and this is the final one which is on our radar with respect to the ratings. Well, we have about 14 analysts out of the 21 which have a coverage on Canfin Homes with a buy rating, and the consensus price target stands around 952, which entails about a 33% upside from current market levels. So all in all, the street is positive. It's bullish on Canfin Homes going in, and that's what we're keeping an eye on. In terms of street credentials too, we have, well, it's been lackluster, but it's been a tough year and tough couple of months for the entire broader markets space. So, which is why we're not exactly looking at the best of returns. And while some might argue that it will be more or less in line with the kind of performance that we've seen in the mid-cap and the small-cap indices, maybe a little bit of an underperformance. Overall, that would potentially be, something of a thumbs down. So, along with that, let's bring all these factors together and talk about the kind of ratings that we have for the company. And based on the several factors that we did address, well, it's been a fairly neutral rating for income statement and balance sheet, operating metrics, and asset quality, on the other hand, looking at a thumbs up. Moving on, we also have an update from shareholding, pattern, street coverage. And the valuation picture is neutral, but street credentials is where we're looking at a thumbs down too. And that actually brings us to a total score of around 5.5 out of 8. So not too bad, even though its growth rate could have been certainly better. So that's as far as Canfin Homes is concerned. But I'm going to stop right there, and I am going to, talk about, rather put the spotlight on, the management. In fact, Harsh spoke to the management of the company about the outlook going forward. Mr. Suresh S. Iyer, he's the MD and CEO. Listen in as to what he had to say.
We had guided that we'll be doing about 10,000 crore disbursement for the year. And in the second quarter, we did see a very positive pickup in terms of disbursements. Unfortunately, this e-Khata issue, which has come up in Karnataka, has hurt us in this quarter, because about approximately 400 crores of disbursement we have lost because of this in this quarter. This particular circular came around end of September. And the entire Q3, we've had the impact of this, where we used to do about, currently 30% of our business incremental comes from Karnataka. So we already have a very high reliance on the southern states for our business, which we have already highlighted that it's about 70% plus, and we would like to, in the next couple of years, bring it down to around 60%. So 60-40 is the kind of breakup we would like to have. So this quarter, we've had this impact, because of which further the growth, which had inched up from 9 to 10%, has further again come down in Q3. Whereas we would have expected it to, with this 400 crores, this would probably have been about 11% plus in this quarter. And end of this year, we would have again been closer to 10,000 crores. But now looking to the issue that we have faced in Q3, this year probably if Karnataka issue doesn't get resolved quickly, then we can expect somewhere in the range of 8,500 to 9,000 crore is where we will end up with. But we are sticking to the disbursement target of 12,000 crore for next year, and that will bring us about 15% AUM growth for next financial year. And going forward also, as you rightly said, we would be targeting 15 to 17% growth, because the market, the demand, the property market, they are all positive. The segment that we are also targeting is also quite steady in terms of momentum, in terms of demand. We also, as we have guided in the past, we have taken certain steps also in terms of branch expansion in the north, in the western states. That is giving us some positive results. Like, for example, last year we opened 14 branches, and we are now almost 14 branches have kind of closed about a year. And they've already started doing about 75 lakhs average business per month, close to 75 lakhs. So that's in line with the target of about 2 years to break even and do well. So they are already starting to contribute. Same way, this year we are targeting another 15 branches, all of them mostly in the north and the west. So this will, going forward, help us, achieve our target of 60-40 geographical breakup between the rest of India and southern states. The second thing the second thing we are also looking at is, having our own sales channel, because we have a high reliance on our DSA network. So while the DSAs will continue, but we are also setting up our own sales channel. That also is slowly improving, and month on month, we started in June, and month on month, we are seeing an improvement in the productivity of the sales staff also. So these are some of the positives. So we are quite confident that at least going forward, we should be targeting and looking at 15 to 17% growth. This year, of course, this third quarter, setback has affected, and we should probably look at around 10%, because if you do around 9,000 crore disbursement, 8,500 to 9,000, we will be in the 10%, closer to 10% kind of a AUM growth in FY25.
Right. You set it up very well, and a few questions on the back of some of the things you've said. So this change in distribution mix, does it somewhere factor in asset quality? How do you expect to ensure that processes will continue to be maintained? Your NPA ratios have always been good, but how do you maintain that when the distribution or the channel mix changes?
See, it's not that we are completely moving out into the newer geographies. Okay, we have had branches in Delhi, in Jaipur, in some of the western places, in Mumbai. So we have we are present actually in 21 states. So it's not that we are looking into new geographies where we don't understand the markets. It is just that we need to look at the periphery areas or the nearby locations where we can look at branches. We also need to look at strengthening the team, because we already have teams which are like having more than 10, 15 years of experience with us in these markets. So what we need to do is we need to strengthen the team, and we need to look at expanding in the existing geographies. That's what we are looking at. So we do understand that compared to some of the southern markets, which traditionally also for housing companies have been very good in terms of credit quality, the north is and rest of the country is slightly weaker, but still in terms of our products, in terms of our policies, we have been very, conservative. We have 70% plus of our book. Even today, we have about 85% of our loans which are given to only for pure housing. We don't have much of LAP. We don't have any exposure to the developer segment. Second, we have more than 70% of exposure only to the salaried segment. So considering these kind of conservative policies and lending practices, I think, these are the ones which give us confidence that our credit quality or credit costs will not go up in spite of our expansion into these geographies.
So as you expand, do you plan to change that mix at all? Does it give you comfort to change that? LAP is obviously a slightly higher yielding segment as well, and therefore putting that question to you.
See, actually, we have, in fact, I've highlighted this in the past also. We have a vision document up to for 2028.
Yes.
So we do want to continue our focus on, salaried segment. Presently, it is about 73%. We would like to keep it 70-30. So the focus on salaried will continue. Presently, our non-housing, excluding our CRE, our pure housing is coming to around 75%. So we would be comfortable with, that also being not more than, not going below 65% in the next 3 to 5 years. So our focus will continue on pure housing. We will not look at expanding LAP too much. We have about 5%, which has slightly inched up to 6%. Probably it may not go beyond 8% even in the next 2 to 3 years. And so our focus will continue on pure housing and also in the salaried segment.
Okay. And so therefore, this 15 to 17% kind of growth guidance, one, how quickly do you get there? Do you get there in FY26? You've guided for 12,000 crore of disbursements in FY26. But does that get you to that number of 15 to 17% growth?
Yeah, if we are targeting 12,000 crore, with that 12,000 crore and considering the rundown that we are having of about 1,300 crores per quarter, which is about 5,000 crores, 5,200 crores per year, we should be able to have a net addition to our books of about 6,000 crore next year, which will get us to around 15%.
Understood. And thereafter, you can continue to sustain that. And what happens to your capital adequacy? Do you issue fresh equity anytime?
See, even at 15% growth, our ROE is around 17% plus.
Right.
So I don't think that will put pressure on our capital adequacy or on our requirement for capital. So it's only when we start growing at rates much higher than that we will have to look at bringing in capital. Presently, also we are quite comfortable. Our capital adequacy is 23% plus.
Okay, so your mix remains the same, and therefore your spreads as well as margins largely will remain in this kind of a range.
Yes, in fact, spread we are quite, we are kind of clear that we don't want to go below 2.5% spread. So that keeping that in mind, we will have to, and therefore whatever little we are pushing in terms of ticket size, where we may have to give an offer, attractive rates or competitive rates, that will be offset by a little bit of expansion in the self-employed or a little bit of expansion in the LAP book. So net, we would like to maintain our spread at 2.5% plus.
And that is all that we have for this edition of KYC, but lots more lined up on the other side. Stay tuned to NDTV Profit.